Size can be a fortress, but it can also be a weight. Megaworld Corporation enters 2026 as a giant in Philippine property, spanning townships, condos, malls, offices, and hotels. The promise of scale is resilience, but a slower, costlier market brings new challenges. In Q1 2026, Megaworld posted 21.60 billion pesos in revenues, a 3.2% increase year-on-year. Net profit grew faster, reaching 6.18 billion pesos. On paper, it's a solid quarter: modest sales growth, rising profits, and a stable balance sheet. But beneath these numbers lies a more complicated picture. The development business grew barely at all, with real estate sales inching up just 1.4%. Despite slow sales, margins provide optimism. The cost of real estate sales fell by 5%, improving margins to 53.4%. Megaworld is extracting more profit per unit thanks to pricing discipline and cost control. Margin expansion stands out in a challenging environment. Yet, operating expenses climbed 10.6%, outpacing revenue growth. Rising selling and administrative costs raise a caution flag. Net margins improved, but if slow sales persist while costs rise quickly, margin gains can erode. Recurring income shines. Leasing revenues grew 5.7%, with offices and malls posting gains from escalations and renewals. Mall leases jumped as occupancy and tenant sales strengthened. This steady income anchors the township model. Hotels added momentum, with a 7.9% jump in revenue from domestic tourism and higher occupancy. Still, hotel costs grew faster than revenues. The balance sheet remains robust. Assets nearly 493 billion pesos. Equity climbed, liabilities declined, and debt fell. Leverage improved. Liquidity bears watching. Cash declined by nearly 15% due to project spending and debt repayments. Receivables grew, with a large portion current. In property, collecting what is due is as crucial as completing the sale. Megaworld's first quarter was not about rapid growth, but about extracting quality from its vast footprint. Development sales are tepid, and costs are stubbornly high. The positives are real: better margins, stronger leasing, improving hotels, and a safe balance sheet. The risks are just as real. Expense discipline and sales momentum must be watched. This quarter reassures more than excites. Margins are sturdier and recurring income is stronger, but growth remains modest. For investors, the story is nuanced. Acknowledge improvements, but remain alert to rising costs and softening sales. Megaworld stands solid. The next challenge is turning solidity into sustainable momentum.